Okay, let's talk silver. The market just went through, well, a real shakeout, didn't it?
It certainly did. A sudden, pretty dramatic move.
We saw leveraged traders getting absolutely hammered, liquidated, and those momentum guys, the ones chasing the quick flip.
Wiped out. Yeah, the volatility was just running at breakneck speed. For a lot of people, that price drop probably felt like a total crash.
It felt sharp, yeah. But we're here to dig into why that might not be the whole story, drawing on analysis from a really respected voice in resources, Rick Rule.
Exactly. His take is crucial right now. He argues this destruction, this volatility we just saw, it isn't the end of the bull market. It's actually, well, he calls it the necessary cleansing fire.
A cleansing fire. That's the paradox, isn't it? The pain is actually making the market healthier.
That's the core idea. Rule's thesis, basically, is that these short-term swings, even a big drop, say, from $50 down to $40 or whatever the numbers are, it's kind of irrelevant to the big picture, the long-term secular uptrends.
So it just shakes out the weak hands.
It performs triage, you could say. It flushes out the latecomers, the ones playing with too much leverage, people who aren't positioned correctly for the long haul.
Right. And Rule has that great line about silver.
Oh, yeah, it's classic. He says when silver really makes its historic move, it pays so much rent, gives such high returns that you can easily afford to be early. You have plenty of time.
Oh.
But given how fast and, frankly, how violent those moves can be, you absolutely cannot afford to be late.
Okay, so that urgency, understanding this specific moment, this reset, is absolutely vital.
Couldn't agree more.
And look, getting ahead of this stuff, it takes sharp insights.
Yeah.
If this kind of thinking, the synthesis of market analysis and physical data is useful for you, we really do urge you, subscribe to Credit Edge.
That's where this kind of time-sensitive analysis lives.
Seriously, don't miss out on what's coming next in this market. Okay, so let's break it down. Why doesn't this short-term pain derail the whole thing? Why shouldn't a disciplined investor panic right now?
Well, Rule draws a really clear line here between, speculative trading and actual long-term investing in precious metals.
Okay.
He points out that this kind of volatility, it really hammers two specific groups. First, obviously, the traders using heavy margin, high leverage.
They're built to fail in these moves, basically.
Structurally vulnerable, yeah. They get liquidated almost by design. And second, it's the people who jumped in really late. The ones who, as he puts it, got the religion of silver in the last 4 weeks.
The FOMO crowd.
Pretty much. They bought the top of a short-term spike, maybe didn't understand the volatility, and they get shaken out fast.
Okay, so they get liquidated, they drive some of that short-term noise. But what's the actual engine for the long-term bull market then? Is it solar panels? Electronics demand?
According to Rule and his decades of watching this market, no. What truly matters in a major silver bull run is investment demand. Full stop.
Investment demand. Explain that.
It's not about the industrial uses, not primarily. It's not even about trading volume day to day. It's the imbalance, the pure delta, between the number of people wanting to buy physical silver as a long-term asset versus those willing to sell it.
So savers moving out of paper.
Exactly. That fundamental shift from financial assets into tangible wealth protection, that is the sole factor that fuels those historic price explosions we've seen in the past.
That still feels a bit counterintuitive given how much silver industry actually uses. Do you have an example, something from Rule's experience that backs this up?
Absolutely. He talks about the time when photographic demand for silver just evaporated. Remember films?
Vaguely. Yeah, huge industrial use gone.
Completely gone, almost overnight thanks to digital. Now, basic logic would say, okay, massive demand source disappears, price should crater permanently, right?
Makes sense.
But what happened? Almost immediately after that industrial demand vanished, Rule says the market saw one of the damnedest spikes he'd ever witnessed.
Wow.
Because the rush of investment buyers, people, institutions looking for wealth protection, maybe seeing inflation coming, they completely overwhelmed that loss of industrial demand.
So investment trumped industrial.
By a huge margin. It proves the thesis. The big moves are driven by investment fear, greed, the desire for tangible assets, not just how many ounces go into a circuit board.
Okay, that sets the stage.
Okay.
Now let's pivot to the physical market right now, because Rule highlighted something flashing bright red, these silver lease rates. What are they, and why are they suddenly so alarming?
Right, lease rates. Simply put, it's the interest rate you pay to borrow physical silver for a certain time. Think of it like renting the metal.
And normally, what's a normal rate?
Historically, the market seemed fine with rates around, say, 3.5%, maybe 4% per year. That was considered sustainable. Traders could work with that.
Okay, and now?
And now, Rule points out that some of the near-month contracts, the cost to borrow silver right now, has spiked to levels like 35% annualized?
Wait, 35% just to borrow the physical metal?
35% annually. That signals an absolutely severe shortage of metal available for immediate delivery.
How does that high cost translate into market pressure? What does it do?
Well, the math becomes brutal really fast. Like Rill explains, many players in these markets are leveraged. Maybe they only have 10%, 15% equity backing their positions.
Right.
If your cost to borrow the physical metal you need is suddenly 35% a year, that cost is just eating through your margin, your capital, at a completely unsustainable rate.
So you're forced out.
You're forced to liquidate. If you're short, you have to buy back the position and return the physical metal you borrowed immediately. It confirms the physical squeeze is real and intense, and it actually makes it worse. His word was catastrophic for anyone caught short the physical.
And this squeeze, this tightness, it's made worse by silver's weird supply situation, right? It's not like gold where a high price means more mines open up quickly.
Exactly. Silver is, as Rule calls it, an odd metal on the supply side. Only about, 30% of newly mined silver comes from actual primary silver mines?
So where does the rest come from?
The vast majority, maybe 70%, is a byproduct. It comes out of the ground when you're mining for copper or zinc or lead, or it comes from recycling old silver.
Ah, so that's the paradox.
That's the structural problem for supply. Even if the silver price goes to the moon, a copper miner isn't going to suddenly start digging a huge new copper mine just because the little bit of silver byproduct is worth more. Their decisions are driven by the price of copper or zinc or lead.
So a high silver price alone doesn't guarantee a flood of new mine supply.
Not quickly, no. You need the underlying base metals demand to justify the new mines first. It makes the supply side structurally tight and very slow to respond to price signals for silver itself. Hard to refill stockpiles in a hurry.
Okay, so summing up this part, the market is screaming physical shortage via these crazy lease rates. Even while the price volatility is shaking out the speculators, it's a real standoff.
A very tense situation.
And synthesizing this, understanding these crosscurrents, is exactly what you need right now. This analysis, straight from Rick Rule's latest thinking, is the kind of edge you get with CredEdge.
If you haven't subscribed, seriously, now is probably a very good time to look at it. Secure your access to this kind of information flow.
Definitely. Let's shift gears slightly. Underlying all this is silver's fundamental identity. Rule keeps insisting it's a monetary metal despite all the industrial use. He uses that phrase, monetary metal in drag.
Yeah, it's a fantastic description, isn't it? His point is that because we in the West see so much silver consumed by industry, we tend to forget or maybe underestimate its ancient monetary role.
But it fits the definition.
It fits both core functions of money. It's used as a store of value, reliably holding purchasing power over time, and it functions in many places as an informal unit of exchange. The in-drag part is because its industrial utility kind of disguises that primary deep-rooted function as wealth.
And where is that monetary function most obvious today?
South Asia, primarily. Think India, Pakistan, Bangladesh, Sri Lanka. For hundreds of millions of people there, gold is simply too expensive for regular saving. Silver is their main accessible store of wealth.
And that's not just habit.
Rule argues it's far from arbitrary. It's based on, and I think this is a direct quote, 1,000 years of experience with the debasement of government currency. They trust silver more than paper promises.
Wow, 1,000 years of experience.
Yeah. And he notes that people's behavior across that whole region confirms that silver is used as that reliable, informal unit of exchange. It acts like money because it is their money in many ways.
Which leads us to maybe the biggest wild card. The actual amount of silver out there, the above-ground supply. With gold, we have a reasonable guess, right?
Yeah, gold's pretty well tracked, around 216,000 tons total ever mined, maybe $15 trillion worth of investable stock. We have a ballpark.
But silver?
Silver's total above-ground stock is, as Rule puts it, one of the great mysteries of the world.
A mystery?
Because unlike gold, which often ends up in big, visible central bank vaults or ETFs, a huge amount of silver exists as scattered, often undocumented family wealth. Think jewelry, heirlooms, small bars, silverware, tucked away in millions of households across the globe, especially in Asia.
Impossible to count.
Virtually impossible. And that lack of transparency makes the market incredibly vulnerable to unexpected supply-or-demand shifts.
And there's that famous story involving Warren Buffett that perfectly illustrates this whole problem.
Yes, that anecdote is absolutely critical for understanding the silver market's dynamics. Rule often tells it. There was a time when the market widely believed Warren Buffett, through Berkshire Hathaway, had accumulated a massive position, maybe up to 20% of the known global supply.
20%, that must have set the price flying.
It did cause a huge spike, naturally. Everyone thought, well, if Buffett's cornering the market, the price has to go up.
But it didn't stick.
It didn't stick. The price eventually rolled over and got crushed. And the reason why is fascinating. And totally unexpected flood of supply hit the market.
From where? Not mines, not vaults.
From the Indian peasantry. Rule explains they faced a double whammy. A bad harvest season coincided with a sharp rise in the US dollar against the Indian rupee. Suddenly, their silver heirlooms were worth a lot more in local currency, and they needed money to survive.
So they had to sell their family wealth, their store of value.
They had a painful choice. Sell the silver or face real hardship, and millions made that choice. This enormous, unforeseen wave of supply just overwhelmed the market, proving two key things, according to Rule.
Okay, what were they?
First, it proved undeniably that for vast numbers of people, silver is their functioning monetary savings, their emergency fund. Second, it proved that any calculation of known supply or above-ground stock is basically guesswork. You simply cannot quantify how much silver is held privately off-grid as generational wealth.
Which means trying to precisely time the silver market based on known inventory is futile.
Fundamentally flawed, yeah. It reinforces Rule's view. You can't really time silver successfully. You have to understand the long-term drivers, position yourself accordingly, and then have the patience to wait for those secular factors to play out.
All right, let's pivot to that long-term view then. Looking ahead, Rule's overall bullishness on precious metals, it seems rooted in a pretty fundamental comparison, right?
It really is. When you boil down his analysis, it comes back to comparing the future utility of owning precious metals, gold and silver as a store of wealth versus the utility of holding what's traditionally seen as the benchmark safe asset, the U.S. 10-year Treasury bond.
And given the outlook for government debt and deficits.
Exactly. Given the explosion in global debt, the ongoing currency debasement, he just sees the relative utility shifting dramatically towards tangible assets like metals. The trajectory, in his view, is pretty clearly upward for tangibles relative to bonds.
Now, he's mentioned some pretty eye-popping potential targets for gold, referencing others like Pierre Lassonde.
Yeah, he specifically cited Lassonde's calculation, which suggested gold could potentially hit something like $17,250 by 2030.
$17,000. What's the basis for that?
That specific number was based on the premise, or the belief, that the U.S. dollar's purchasing power could decline by as much as 75% over the next decade or so. Rule himself has said that if you see that kind of purchasing power erosion, a tenfold increase in the nominal dollar price of gold wouldn't be surprising at all.
Okay, a tenfold increase in gold is massive. If gold does anything like that, what does silver do? You called it the more emotional metal earlier?
Silver basically acts like gold on speed, or gold with leverage. Because it's a much smaller market, historically much more volatile, when it finally decides to outperform gold, which it typically does once a real precious metals bull market gets going. Rule's experience shows its rate of climb tends to be at least double that of gold.
Double the percentage gain.
At least double. It offers that much higher potential percentage return, that explosive upside. But the trade-off is you must be able to stomach the gut-wrenching volatility along the way. Like the shakeout, the cleanse we just witnessed, that's part of the deal with silver.
Okay, so let's try to synthesize this for everyone listening. We've got this recent volatility, which Rule sees not as failure, but as a necessary market cleanse.
Right, shaking out the wrong players.
Then we have the underlying drivers, investment demand. Silver's persistent monetary role globally still very much intact.
Absolutely. Those are the long-term engines.
And critically, the physical market is showing signs of extreme tightness, even crisis, confirmed by those catastrophic lease rates.
Yeah, the physical side is flashing warning signals.
So the final message from Rule's analysis seems to be a warning.
It is. It's a warning and maybe an encouragement. The warning is the next major leg up in this bull market, when it comes, will likely be fast, it will be violent, and it will be unforgiving to those who aren't ready.
Rewarding early positioning.
Exactly. It rewards being positioned correctly before the move happens. It punishes chasing momentum after it's already started. The volatility we just saw, that was the market coiling the spring, loading up energy, not breaking.
That's a powerful way to frame it. And it brings us back to that market truism rule also mentioned.
Oh, the old saying, the cure for high prices is high prices.
Right. Meaning that eventually this extreme squeeze, these high prices, will eventually draw out more supply. Even that mystery silver, the hidden family wealth, might come to market if the price gets high enough for long enough.
Over time, markets do tend to work. That supply will likely emerge eventually. But the near-term pressure, the signals from the lease rates right now, they confirm just how severe the current supply shock actually is.
The key lesson then is, don't mistake this short-term pain, this volatility, for a breakdown in the long-term story.
Precisely. Stay disciplined, stay positioned if the thesis makes sense to you.
Look, this kind of forward-looking analysis, connecting all these dots, it's absolutely essential in markets like these. You really need access to this time-sensitive commentary to navigate.
Couldn't agree more. Things are moving fast.
So, one last time, make sure you don't miss what's coming. Get the insights you need. Subscribe to Credit Edge now. We'll catch you on the next one.